Yeah, so I was listening to this clip, and I try to have a decent mix of alternative media, and then I'll kind of tune into some normal kind of mainstream channels just to see who's talking about what. And for whatever reason, this one popped up in my feed, and I clicked on it, and I think it was like after the first 2 minutes I sent it to you, and I was like, oh, I want to do an entire episode on this, but let's play it, and we'll talk about it for a few minutes.
Yeah, yeah, and we'll expand on it later. Just shout when you want me to stop. Here we go.
Eggs keep popping up for the U.S. housing market. Sticker shock, sky high mortgage rates are leaving buyers frozen, sellers trapped. Goldman Sachs expects home prices to grow just half of 1%. That is the slowest pace in 14 years. That is for the entire year. And now Moody's top economist says that the housing market has the potential to become a full blown headwind for the entire U.S. economy. Jade, that makes sense because if the housing market gets completely locked up and there's no buying or selling, that does have a follow-on effect for the economy because when you buy a home, whether it's a new one or even an existing home, a used home, you do spend a lot of money to fix it up or even furnish it.
That's right. I think right now there's just a lot of fear surrounding the housing market in general. And it depends on what part of the country you're in. If you go to South Florida, yeah, houses are sitting on the market for a very long time. You go up to Nashville, buyers still have a little bit of an edge there. So it just depends on where you go. But I like to just encourage people that there's still hope. You and I were talking about this on the break. There's still hope. The average house is sitting on the market for 52 days. So if you're looking to sell, you will get out. You've just got to be patient. And if you're looking to buy, you've got to be patient as well. So really just aligning our expectations. I kind of feel like a lot of us are just really stuck in the past as far as interest rates and what we should be paying. And I think the quicker that we can just accept where we are and kind of realize that what took place throughout the pandemic, those really low rates and real estate being hot, that was abnormal. But if you really look back from the 70s even until now, we have, the average rates 6 to 8%. Like that's kind of been the sweet spot. And so the fact that you can get a 15-year for just under 6%, you can get a 30-year for 6.8. That's not all that abnormal when you look at the grand scheme of the timeline of how the real estate market has looked over time.
Yeah,
Yeah, I get the point.
I don't think I can handle a whole lot more of that. All right, so look, like there was a couple of things. I'm glad we played it again because I even caught a bit more of it. It like a friend of mine that I work with likes to say, you're right and wrong at the same time. And I think that when the thing that stands out to me about that clip is like the delivery for commentary. She's trying to be very positive and telling everybody that we need to realign our expectations and different things like that. And look, that's true, right? You can't change where you can't change the global economy. So yeah, you have to adjust to where you're at. But I think in adjusting where you're at, it's good to frame that in a little bit more context to be able to say, yeah, okay, average interest rates, normal interest rates, median interest rates, however you want to say it, over the last 50 years, let alone 200 years, typically money costs about 6%. 6%, 8%. That's what money's cost for millennia, right? Somewhere in that range. And that's all fine. That all makes sense. But when she's saying that, in the 70s and even the 80s, interest rates were 16, even 18%, right? And we kind of in presenting that data point with kind of this undertone of like, hey, we should be happy with where interest rates are today. Well, hey, guess what? I would ask people, go look at what the median income was in 1975 or 1985 for that matter. Go look at what the median home monthly mortgage payment was. Go look at what the median price of a gallon of gas was, or eggs or bacon or orange juice or anything like that. And then compare those costs and prices to today. Right. And then also like I was talking to you about offline, I want to put this on a graph for everybody so everybody can see it. Wages adjusted for inflation have stayed just about completely flat over the last 40 years, right? Where assets have 10x, if not more, right? And now, since the pandemic, commodities have exploded, right? A gallon of gas is much more expensive than it used to be. And that has a knock-on effect into every other commodity that you would purchase, right? There's supply shocks, there's demand shocks. That's a longer video across the board. But one other thing that I kind of want to mention, and it kind of dovetails to something else that's been kind of hot in the news cycle lately, but I want to stop there really quick and get your feedback on just those data points, right? Like the way she's framing that versus the reality of where we've come from over the last 40 years.
Yeah, I mean, you and I talk about our parents and how a 14, 18% mortgage rate was not a big deal, but they were still only paying like $1,200 a month. And
Right.
they had, a 900 square foot house, and that was good enough.
Right.
Their car hardly cost anything. Everything was paid for in cash.
Yeah.
I mean, I
A
think
house
most of
that
the bigger
a house
picture-
that they bought, by the way, for 90 grand, that's now probably worth 859, a million, right?
Exactly.
And gas was what, 40 cents a gallon?
Yeah.
It's not the same.
Well, and Timo goes to the bigger picture. I mean,
Yeah.
for me and my family, real estate is how we have gotten to the wealth independence level that we are right now. We bought our first condo in Chicago, sold that for a profit, bought a place during 2008 at the bottom of the market in Stapleton, Colorado, and rode that up by 150 grand. And then we moved to the next house and rode that up. And we were able to keep stepping up to the point now we are on our house outright in cash, right? Only because we were able to leverage the capabilities of real estate and low rates to be able to do that.
Right.
One, to her point, that's really not possible anymore, especially if you're a dad trying to get into buying a house right at the beginning of this horrible market for the first time. Renting, buying, I mean, that's a challenge right now. And that also came up in that video.
Yeah, and the what was it, the Moody's analyst saying that home values would likely only appreciate like 0.5% this year, right? And just like you said, like the journey that your family has been on, which is fantastic. I mean, one, congratulations. I didn't even know that, but like, we have pulled forward, but by keeping interest rates artificially low when we really didn't have to, like we really didn't need to take interest rates to the zero bound, right? And then leave them there for a decade, and then change all kinds of banking regulations to allow massive organizations to lever up on all kinds of debt instruments, right? That also affected housing, right? All of that pulled forward a lot of that price appreciation that would have kind of naturally matured over a 20-year period in housing. It condensed all of it into like 8 years, right? Yeah. Minus the dip of '08, right? But then things have more than rebounded since then. And it's like at some point you're gonna have to have a leveling off, right? Especially when we're in a tight market right now where people can't buy and people can't sell for what they want, so people are stuck, right? When you have that market dynamic, like, yeah, price appreciation is going to level off 100%. It's unfortunate, but I think it's definitely very true. And it was funny how she was talking about how like people over here that are buying may have a little bit of an advantage, whether, against people that are trying to buy in a different market. And that's true. Like real estate across the United States is not one market. It's 50 different markets, right? It's hundreds of different markets. And what's interesting to kind of go into one of the things that's in the news cycle right now is the Federal Reserve, right?
Yeah.
The reason why there's 12 member banks of the Federal Reserve, right, is there used to be regionalized interest rates across the Fed. So the borrowing rate in California wouldn't be the same as the borrowing rate in Jackson, Mississippi, because they're different economies and money should cost something different based on market demand in those regions. But I believe it was the Banking Act in 1934, 1935 that modified that bank charter and gave us one federal interest rate. And that's actually one of the things that fed the boom in California and the relative bust in like the Dust Bowl and other states, because all of a sudden all of this productive capacity shifted to the coasts because they could borrow at the same interest rate as Missouri. How much
Yeah.
sense does that make? Like when you just think about that, like on its face, how much sense does that really make? Right?
Yeah.
Yeah.
Yeah. It's a shame.
I know.
And people that want to get into a house and want to grow wealth right now, they can't do it in real estate unless they have that 20% down, and 20% of any median priced home, you know, 650 grand is massive, right? You're going to need $120,000 to be able to pull it off.